Welcome to our comprehensive tutorial on the Modigliani-Miller Theorem. This foundational concept in finance is pivotal to understanding corporate finance and capital structure. Whether you're a finance student, professional, or enthusiast, we've got you covered with detailed explanations, real-world examples, and interactive Q&A. Let's dive in. The Modigliani-Miller Theorem, named after Franco Modigliani and Merton Miller, forms the bedrock of modern corporate finance. Introduced in the 1950s, the theorem posits that in an efficient market, the value of a firm is unaffected by how it is financed, whether through equity, debt, or a mix of both. To understand this better, consider two companies. Company A is financed entirely by equity, and Company B is financed by a mix of equity and debt. According to Modigliani-Miller, both companies should have the same value if we assume an efficient market with no taxes, bankruptcy costs, or asymmetric information. Let's apply this with a practical example. Suppose Company A and Company B both have the same projected cash flows of $200,000 per year, with a discount rate of 10%. Company A is equity financed with 1,000 shares outstanding, whereas Company B is 50% equity and 50% debt, with the debt carrying an interest rate of 5%. For Company A, the value of the firm would be calculated as follows. With cash flows of $200,000 and a discount rate of 10%, the value, P_0, is 200,000 / 0.1 equals $2 million. Each share is valued at $2,000 since there are 1,000 shares. For Company B, the value of equity is derived after accounting for debt. The debt payment is $50,000 per year, 5% of $1 million. Subtracting this from the annual cash flow gives $150,000. With a 10% discount rate for equity, the equity value is 150,000 / 0.10 equals $1,500,000. Adding the $1 million in debt gives a total value of $2,500,000. You might wonder, doesn't this contradict the theorem since Company B's value is $2,500,000 compared to Company A's $2 million? Remember, this example includes debt benefits. In a world without taxes and other frictions, both should align. Let's dive deeper by considering some questions. Q1. What happens to the Modigliani-Miller theorem in the presence of corporate taxes? \NA1. In the presence of corporate taxes, interest payments on debt are tax deductible. This creates a tax shield, making debt financing cheaper and increasing firm value when considering taxes. Q2. How does bankruptcy cost impact the theorem? \NA2. Bankruptcy costs introduce an incentive for equity financing. As debt levels increase, the risk of bankruptcy, with its associated costs, also rises, which may deter heavy debt financing. Q3. What role does asymmetric information play? \NA3. If insiders have more information about the firm's prospects than outsiders, equity issuance can signal overvaluation. This makes companies preferring internal financing and retaining earnings, challenging Modigliani-Miller's assumptions. Now, let's evaluate data from real-world corporate finance. Assume we have three companies, Y and Z. Companies X and Y operate in a tax-free environment, while Company Z operates in a taxed environment. All three have the same EBITDA of $500,000. Company X is all equity financed. Y is a balanced mix of debt and equity, and Z has heavy debt financing due to tax advantages. Company X reports a market value of $3 million. Company Y, with a mixture of equity and debt, reports $3,100,000, while Company Z, with heavy debt financing and tax shield benefits, is valued at $3,500,000. From this data, we see the impact of tax benefits on firm valuation with Company Z. However, Modigliani-Miller tells us that, adjusting for market conditions and assuming no frictions or imperfections, these differences should align over time. To conclude, The Modigliani-Miller Theorem offers a simplified yet powerful view on capital structure. It introduces the concept that financing decisions should not inherently affect firm value in a perfect market. Real-world imperfections like taxes, bankruptcy costs, and information asymmetry complicate this view, but it remains a vital starting point for understanding corporate finance. Thank you for joining this deep dive into the Modigliani-Miller Theorem. We hope this tutorial has clarified this crucial finance concept. Please subscribe to our channel and leave your questions or comments below. Stay tuned for more in-depth finance tutorials.